Hi, this is Kurt Kringles, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The sell-off continued across the fixed income markets in October, but spreads peaked mid-month and moved tighter through the end of the month. The corporate market showed the weakest recovery, with heavy new issuance being perhaps the best explanation. Any concerns about European growth or the timing of rate hikes by the Federal Reserve should have been echoed by the EM and high-yield markets, but both markets performed better than the corporate market. In addition, revenue growth for the third quarter was roughly in line with expectations, and earnings growth came in strong, so earnings results do not explain the relative weakness. Furthermore, any concerns about commodity price weakness should have impacted the EM and high-yield markets more, given the higher weighting of the commodity-related industries within these markets. Within the U.S. investment-grade corporate market, all industries posted negative excess returns for the second consecutive month. Excess returns remained sharply negative for the commodity-sensitive industries as commodity prices continued to weaken. The less cyclical industries generally outperformed the market. Lower commodity prices should reduce input costs for issuers in these industries and also boost the purchasing power of consumers. The financial industry was the top performer for the month. Performance was aided by a number of factors, including lower commodity exposure, less event risk, and a more defensive, shorter maturity mix. On a year-to-date basis, the industry excess return positioning continued to evolve in response to further market weakness, but the bulk of the market still remains fairly tightly clustered. During the past 2 months, the financial and utility industries have had the most notable improvements in rankings as they have moved from being market laggards to being among the market leaders. In contrast, the energy and basic industries have had the most notable declines in rankings. The basic industry was among the top performers and is now in the middle of the pack. The energy industry was in the middle of the pack and is now the worst performer. The communications industry still maintains a commanding lead, but has given some ground during the market weakness. Spreads continued to widen in October, despite a sharp recovery in equities and a decline in volatility. While these factors have been useful indicators of corporate spread direction, other factors have dominated in recent months. We believe that the sharp swings in Treasury yields and heavy new issue supply have been the primary influencing factors contributing to wider corporate spreads. New issue supply is expected to remain heavy throughout November, so we now see less opportunity for spreads to recover to the year-to-date low point reached at the end of June. Corporate spreads have almost always tightened in December, so we still expect some spread tightening heading into the end of the year.